Let's quickly go through. I think we stopped it there. So the main objective of LKS 1 is to ensure that people are provided with financial statements, especially in the case of those who does not have access to the financial statements of a company or an entity all the time. Okay, because the shareholders of the company have access to the financial statement, but the outsiders or the other stakeholders may not have access to the financial information as and when they want. So as a result, this standard LKS1 talks about how the financial statement should be prepared for the general population. So we call that as general purpose financial statements. And these general purpose financial statements are actually prepared to meet the needs of users who are not in a position to require an entity to prepare reports tailored to them. Tailored to them means as per their requirements. As per their requirements. So in terms of that, the LKS1 has specified how the presentation of the financial statements should be, the structure, and other minimum requirements. And we also looked at the purpose of the financial statements. So the purpose will be mainly targeting to provide the financial position, the performance, and the cash flows. Okay, and we also talked about the management stewardship of a company, that is how the company is managed by the directors and also the management in the sense it could be the corporate management or the senior management. So we need to know how the company manages its operations, because poor management can lead to a poor financial position, a performance, and a set of cash flow. Okay, so why there is a relationship between these two is because a company being managed poorly can result into a bad performance. So that is what the relationship between those two. Then we also looked at the objectives of financial statements, where the objective goes on to say that the company should disclose, we say disclose or the provide information covering the following aspects. What are the aspects? Assets, liabilities, equity, income and expenses, then contribution by and distribution to owners, and finally the cash flows. So you know what an asset is, what a liability is, and what an equity is, because that was our rather second or third topic that we covered. So for somebody to understand what the asset base of a company is, how much of liabilities that they have, how these company is backed by finances, that is equity, and based on these how the company is performing, that is your income and expenses, which gives you the profitability, right? Once the profit is earned, there is a requirement for you to distribute a portion of your performance to the shareholders, that is your owners. So we call that to be the dividend. When you pay to your shareholder, it will be dividend. But it is not only the payment that you made to the shareholders, but also the company also might require finances from the shareholders, because whenever they require funding, the easiest way, or rather I would say that it is the easiest access that they have is to the shareholders. But having said that, it is very costly. It is very costly, right? because you have to call for a meeting and then you have to get approval. So many procedures are there, right? But still, that is something where you get from the shareholder. So that will be known as the contribution from the owner. The dividend that you pay will be the distribution. So there is a contribution as well as a distribution. So the result of asset, liability, income, expense, everything is ultimately your cash flow. Your cash flow. So depending on those requirements or those lines, a set of financial statements have to be prepared, right? So the statement of assets and the statement covering the assets, liabilities, and the equity, of course, is given in the statement of financial position. Your income and expenses are covered in the statement of profit or loss and other comprehensive income. And the equity is explained in detail. That is starting from your capital, your retained earnings, and also other reserves that you might have. All are covered in the statement of changes in equity. And then you give a statement of cash flows. Thereafter, you need to provide explanatory information, which are called notes to the financial statements, to explain certain things that are in your financial statements. Now, these also, you also do it. Now, in an exam question, sometimes you might have to provide workings. So, similar to the workings that you provide, why you provide workings? That is to understand how you have derived a particular answer. So likewise, even in these financial statements, to make the reader understand better, we may need to provide certain things. And those include the notes, accounting policies, and other explanatory information. Then we also said that the financial statements should be in compliance with the LKSS and SLFRSS. So what do you mean by that? That is, if you choose to comply with the SLFRSS and LKSS, then that compliance should be disclosed. That is, I have prepared the financial statements in compliance with the SLFRS and LKSS. If you have complied, then those standards have to be followed in full. You can't just do piecemeal application. That is, you do apply part of the SLFRS and you don't apply the full standard. You can't do that, right? Then you need to also remember that use of an inappropriate accounting treatment, that is, you account for something in the wrong manner. After doing that, you can't go and say that, look, I have done this based on this or the use of this accounting treatment. That kind of an explanation cannot be given to rectify an error or an irregular treatment. So that needs to be amended or adjusted in your financial statements. Then we also spoke about how you present your financial statement. So for those to be it to be a fair presentation, first you have to select the appropriate accounting policies and you have to apply them. So when a company provides their financial statements for auditing purposes, what the auditor will first do is to go through the accounting standards that you have adopted in preparing your financial statement. Secondly, they will see whether those standards have been applied in compliance with what is meant there. The standard may be saying one thing and you do something else. No, you can't do that. That is what the auditor will check. And then the auditor will also go on to say that what are the discrepancies that you have made if you have done anything. right? Then once that part is over, you need to know how the presentation of the financial information should be. This we have already gone through. That is, it should be relevant. You have to provide reliable information. And I also spoke about how comparable it should be. And more importantly, it should be understandable. Finally, we talk about the disclosure part. That is, wherever that is required, you may provide a note. It's kind of a note explanation that you will provide to substantiate your financial statement, so the reader will understand better. That is what disclosures are. So, then we also said the underlying concept or assumptions. I'm so not going in detail because we have already covered these. Then I also spoke about the aggregation and offsetting. Aggregating is where the information may be added together without presenting them separately sometimes. But there can be a situation where there could be dissimilar items. So these dissimilar items cannot be aggregated. Okay, you can do that only if they are individually immaterial. Individually immaterial. So you have to be very careful. Now, if you look at a financial statement, I think when we met last time, I wanted you all to go through certain financial statements from the stock exchange or maybe from your company, just to have a look at it. Now, there are instances where uh, people would have presented the financial, say for example, now in the presentation of the bank, there are captions like where you say due to banks. Now, this due to banks means a bank where they are liable to pay something to another bank. So mostly what is presented here is in terms of the borrowings or deposits that the particular bank has made. And similarly, being a bank, you also have customer deposits. So there are two captions if you really look at the financial statement, where they say due to banks and due to other customers. So somebody can easily aggregate these two and so show one as due to customers and banks. But the importance is somebody should know how much is uh, payable to the customers, because in the situation of a crisis, the customer comes first. They have to be paid, right? So you would have recently you would have observed what happened in the business environment in the recent past, where I can take one example. Maybe just pardon me for quoting this name of the company, where the ETI Holdings. So you know what happened with their depositors. So still the depositors haven't got their money in full, right? So this is where the stewardship and what you present becomes very, very important, because it directly have an impact on the performance of the company. Okay, so the aggregation can be done. Having said that, it can be done only if the individual items are immaterial. Then I also explained offsetting. Offsetting cannot be done unless otherwise permitted by a standard. Now, say a customer having a deposit with you and has taken a loan also, say 100 million of loan, and he has given a deposit of 60 million. Now, you can't say that this customer has to pay me a loan of 40 million. That is 100 million set off against the 60 million, and you show only a 40 million of loan where the customer is supposed to pay. No, that's wrong. That is what offsetting is called, but you are not permitted to do that. You are only permitted to do that in certain instances as provided by the standard. Then we also spoke about comparative information. I have already spoken about it. So, and I showed you the financial statements also, where it showed the immediate past financial year for the comparative detail. Then we also spoke about the disclosures, right? What you have to disclose, where the how you have measured and specific accounting policies and so on. Then we also spoke about what are the other details that you have to present in your financial statements, name of the company, whether it is a single entity or a group, then the date of the reporting period, because that is very important with regard to the financial information that you disclose, because if you take a statement of financial position, it is as of a particular date. The P&L or the income statement is for a period. Statement of changes in equity is for a period. And statement of cash flow is also for a period. So it is only the statement of financial position that you will have for a particular as at a date. So you have to remember those when you are doing the examination question. Then we also spoke about the presentation currency, that is whether you are presenting it in Sri Lankan rupees or the currency that maybe say US dollars or whatever. But the presentation currency mostly depending on where the company is domiciled, right? So here a company is, if it is located here in Sri Lanka, the currency used by that company will become the most important presentation currency. Okay, because that is going to be the functional currency as well. We will learn it under LKS 21 when we do that. There is a relationship between the presentation currency and the functional currency. But say, suppose a company, a US company established in Sri Lanka. Okay, so if they are required by the law to present financial statements here, they might do it in Sri Lankan rupees. But if the company is supposed to have a parent in US and this is going to be a subsidiary of that, then the parent might include this information of the Sri Lankan company in US dollars in US. So we need to know this difference when it comes to the presentation currency. We will learn it later under LKS 21. Then I also spoke about the level of rounding, where we show it into the nearest rupees or thousands or 100,000s or millions. So that is called the level of rounding. Right. Then I also said that how the items are disclosed, that is some items will be disclosed on the face of the financial statement. And I showed you the financial statements also, I think. So you can do that provided wherever necessary, you will give a note into the financial statements. Then we spoke about the statement of comprehensive income. The statement of comprehensive income is basically your P&L. It will have two components. We call this as the profit or loss and the other comprehensive income. So you have two components in your total P&L. The total P&L is known as the statement of comprehensive income. That is what you prepare in your examination. But the statement of comprehensive income has two components. What are the two components? It will have a statement of profit or loss and a statement of other comprehensive income. So people will present this in various ways, right? And I showed you how these financial statements are presented by taking example. And the statement of financial position is basically your balance sheet. Okay. So in addition to the balance sheet, there will be information required to be provided with regard to your stated capital, that is your share capital, and any other information related to its composition. Right. Then we came into the section that is on current, non-current distinction. Current, non-current distinction. Okay. So when you are looking at your statement of financial position, that is your balance sheet, your assets and liabilities are presented. Your assets and liabilities are presented. So these assets and liabilities are presented in a particular order, right? In a particular order. Can somebody tell me what is this order is?
Liquidity order.
Liquidity order, in the order of liquidity. And I also said how this liquidity differs from company to company. Can somebody tell me how this differs?
For financial institutes,
Yes.
most liquid assets comes first.
For whom?
For
Now,
banks,
for banks, yes, because if it is a financial institution, right, where their primary business function is to manage finances, means they are a financial institution. So those kind of institution, if you look at their composition of the financial statement of financial position, they are highly liquid. They are a highly liquid organization. But if you take a company who is manufacturing, let's say, garments, now it is not the cash that is important. It is the stocks that they maintain, right? It is the raw material that they have, because that is what could be the major component of their business. So we have financial institutions and non-financial institutions. Financial institutions will have the assets and liabilities in the order of decreasing liquidity. Very important. Please make a note. It will be in the order of decreasing liquidity. The most liquid item, as one student said, the most liquid item will be at the top. But when you take a non-financial organization, where like a manufacturing organization or maybe a trading company, where they will have their financial statements in the order of increasing liquidity. So in their case, from the top, it will be the most illiquid asset will be at the top, like the fixed assets. But the most liquid asset, like cash, will be at the bottom. Okay. So that is very, very important when you try to understand how these financial statements look like. Okay. So let me just try and give you another. Yeah, let's look at a financial statement, then it will give you some idea. I hope that you all have not forgotten anything with the 2 to 3 weeks break. That's why I just wanted to have the class, because otherwise it will be just left over. Right. So I'm just going to present you two financial statements. Right. Now this is of Haley's PLC. You all can see the screen, right? You can see the screen?
Yes, sir.
yes, sir.
Right. By the way, did you all get these financial statements? Was it there in the portal?
No, sir.
Oh, I see. I'll make available maybe some latest financial statements. Did any one of you all go through the financial statements of your company? You could have easily done that, because by being at home for 2 to 3 weeks, you would have had access. So please go through them. But I'll also try and make available in the portal. Okay, right. So Now this is Haley's PLC. You look at the financial position, statement of financial position, right? And I told you this is consolidated, means that is the group. This is the parent or the company. So this is about Haley's company. This is about Haley's group. And you will see this is as at 31st March. So what does that mean? What is the financial year? What is the financial year of Haley's PLC? Anyone?
31st March 2019.
Yeah, I mean the time period from when to when?
1st of April of previous year to 31st
Very
March of
good.
this year.
Yeah, so you can see that in the statement of changes in equity if you really look at it. Now you see here the statement of changes in equity is starting from 1st of April 2019 and it finishes 31st March 2020. Okay, so that is their financial year, right? So going back to the financial statement, then you also have the level of rounding, the financial statement level of rounding. So how they are presented? They have presented in rupees 1000. So if it is rupees 1000, what is this value? What is this highlighted value? How much is it? Yes,
88,485,496.
no, wrong. What is
88
the
billion 485,000 495,496,000.
very good. So the first two digits, 88 is billion, BN. Then the 485 is million, MN. Then you get the 496, where you will add the 3 zeros also. So that will be the full number, right? So here you have the comparative 2020 and 2019. And here they talk about as at 31st March. How you read this financial statement is as at 31st March 2020 is this. As at March 31st March 2019 is this. So this is the immediate year. This is the previous year, right? Then you have assets, right? Then you have equity and liabilities, and then you have the liabilities. So how they have presented the assets? Just look at it. They have the non-current assets and the current assets. That is what we are going to look at next. So they are having a segregation of non-current assets and current assets, right? That is how they do this presentation. Now, why these are given into non-current assets and current assets? Now, the non-current assets will have mostly the illiquid items. Mostly these are very, very low liquid items. Okay. And among those also, you will have the least liquid item at the top. You see, the property, plant and equipment. Now, property, plant and equipment, you don't expect is to be sold immediately. And you won't be able to sell it immediately also. You now say, suppose you have a factory. Can you sell it overnight? If there is a crisis? No, you can't do. You may have to publish in the newspapers, and then you have to look for buyers. unless somebody who will come and take over you. Now say you are a manufacturing company and there is another manufacturing company, they will come and take over you. Then you can sell it overnight. But if not, you can't materialize this 88 billion into cash. Now see, you must be wondering why Alis has 88 billion as fixed assets. Okay, so if we are to actually look into the details, you need to go into this detail 13. Okay, you have to go to the notes, but unfortunately I don't have the notes here with me. If you go to the annual report of Haley's, you can see that what they have under this 88 billion, right? So likewise, what happens, the level of liquidity increases up to here, but when it goes to current assets, that will have mostly the most liquid assets. So even within that, there is a listing how the most liquid item will be at the bottom, right? Within there also, I think there is a ranking. You see, inventories, that is your stocks will be at the top, and then there are so much of other items which you are supposed to or convert into cash, right? So that is the order of liquidity when it comes to the trading company. Even liabilities are like that. You will see non-current liability and current liability. Okay, we will look into the segregation in the handout. I will also take Sampath Bank. Now when you take Sampath Bank, this is their asset composition. What is there on top? What do you get on top? Cash. And if you see, when you go on right away to the down, property, plant and equipment are here in this position. So here what happens, the most liquid item is at the top. So this is a decreasing order of liquidity, and this is increasing order of liquidity. Okay, you have to remember that, very important. Even in your exams, they might want you to answer that. Right, now let's go back to the current non-current distinction. So an entity must present current and non-current assets as separate classifications on the face of the statement of financial position. So what I showed you is the face. Actually, the financial statement that you saw now is called the face of the financial statement. Anything else will go into your notes. It won't be shown on the face. So when you are showing the face of the financial statement, it should have this current non-current classification. But let me ask you a question. When I showed you the Haley's company financial statements, it was there. But when it was Sampath Bank financial statements, why it was not there? Anyone? Anyone can anyone tell me why the Sampath Bank financial statement didn't have that current non-current classification? Yes? Anyone?
Because of the structure of the financial statements
Because why both are under LKS1, no?
Yes, but central bank is the regulator.
Very good, very good. That is where I wanted. That is the answer that I wanted. When it comes to Sampath Bank, the central bank is a regulator and they have given a specific template to present their financial statement. So as a result, what happens, whatever that is required by LKS 1 is getting overridden by this presentation. Okay. So you have to be very, very clear with why there is a difference between the financial statement of a bank and a normal trading company. Okay. Right. I think there is one person unmuted. Can you mute, please? Okay, thank you. Right. So I spoke about the liquidity order. Right. So now we have to look at what is this distinction is. What is current and what is non-current. Now, when you talk about assets, assets are anything that is receivable to you. Okay. That is receivable to you. Now, when you look at a business, you might be having so many things that are receivable. You might sell goods on credit. Later on, you will receive money. You might be having stocks, which can be converted to cash later. So there is a timing for every asset that you have. It may not be converted to cash immediately. So what do you mean by current and non-current is anything that is recovered or settled within the next 12 months of the balance sheet date. Okay. That is, if you say as at 31st March, that is up to 31st March of next year is the next 12 months. Or if you are a 31st December company, whatever that is up to the 31st December of next year is going to be your next 12 months. So whatever that is recovered or settled or expected to be received within the next 12 months is called a current asset. All others are non-current assets. So it's very simple. From the balance sheet date, anything less than 12 months is going to be your current assets. More than 12 months will be your non-current assets. So that is why if you really look at this Haley's company's financial statement, you see what is shown under current assets? Inventory. So inventory, they don't expect the company to have it for more than 12 months. It has to be sold immediately. Sorry. Trade and other receivables, that is their debtors. So you don't expect the debtors to pay after 5 years. No, they have to pay immediately. Like their items, short-term deposits, cash, assets classified as held for sale. So all these are very, very short-term nature of assets. That is why those are current assets. But look at what is non-current. Property, plant and equipment. You don't expect to sell it within the next 12 months unless there is a crisis. Okay, because that is why you have a going concern. When you are preparing financial statements based on going concern, you don't expect anything to be sold within the next 12 months like these items. So most of these items are something that gets realized or materialized after period of 12 months. That is why those are classified as non-current assets. Similarly, if you look at the liabilities, right? So liabilities also, you can say liabilities could be settled within the next 12 months are your current liabilities. Whatever that can go beyond the 12 months will be your non-current liabilities. Now let's look at what was there under Haley's as current liabilities and long-term liability. Right. Non-current liability, let's look at those. interest bearing borrowings. So these are things that they have borrowed maybe for a longer period. If you have taken a loan which is payable in 3 or 5 years, that will be a long-term liability. So long-term liability or non-current liability means the same. But look at what is current liability. Trade and other payables. Trade and other payables means that is the creditors. Then they have other current liabilities, deferred revenue. So these, some of these terms may not be familiar to you because still we are in the process of learning these terminologies. But just remember, this you know, trade and other payables means that is creditors. Then you have income tax payable. So if you have earned a profit, you have to pay tax. You can't say the Indian revenue or the government that you will pay tax maybe after 5 years. That you can't say. So those are immediate liabilities. That is why it is current liability. So the segregation is same, whether it is payable within 12 months or not, right? So what is the definition of a current asset? An asset can be classified as a current asset when it is expected to be realized in or is held for sale or consumption in the normal course of entity's operating cycle, right? Or it is held primarily for trading purposes or for the short term and expected to be realized within the next 12 months in cash or a cash equivalent. Sorry. So these are the instances where you can consider something as current asset. Okay. So this is the theoretical definition, but in examination, you can simply say, what is a current asset is anything that is receivable or recoverable within the next 12 months for a company from the balance sheet date. That is what here it is said now. See? Right? So it could be an asset or a liability. So either you recover it within the next 12 months or it could be more than 12 months. That is the simplest definition that you can provide. Right. And similarly, you will have liabilities. What is considered as a current liability? Where it is expected to be settled in the normal course of entity's operating cycle. What is operating cycle? I will explain. Is held primarily for the purpose of trading, is due to be settled within 12 months after the reporting period. The entity does not have as an unconditional right of defer settlement of the liability for at least 12 months after the reporting period. So these are like liabilities which can arise immediately within the next 12 months. Right? So now since we have the current assets and current liabilities, you can define a terminology in accounting which is known as the working capital. Working capital. This has nothing to do with the company's stated capital or the share capital. Okay. This is the working capital. So what do you mean by working capital is, it is the difference between current assets and current liability. Please make a note. Working capital is current assets minus current liabilities. Current assets minus current liabilities. Very, very important. So what do you mean by that actually? Current assets minus current liabilities will give you the working capital. So what do you mean by working capital actually? Working capital is the amount that is required to meet your day-to-day operations. Okay. Now, when a company requires share capital means or stated capital means, that is for long-term expansion. but the business has to run in the short run. So in the short run, when the company is required to run, they need to have capital. That is called working capital. How this working capital is made up of? It is the difference between current assets minus current liability, or the formula per se. If you look at it, working capital is equal to current assets minus current liability. Now, what do you mean by that? Current assets will have all assets that you can, you are expected to receive within the next 12 months. Current liability is all what you have to pay within the next 12 months. So the difference, if you take, actually, if there is a surplus, a positive number, then only you can call it as a working capital, right? Say, for example, your current assets is 100, current liability is 60. So what is your working capital? It will be 40. But if it is like where your current assets is 80, current liability is 100, then you have a negative working capital of 20, which means it's a crisis situation. If you are having a negative working capital, then that's the end of the company, because you are struggling to meet your liabilities. So it shouldn't be the case. Always you should have a positive working capital. Okay. Right. So we come to the topic of operating cycle. What do you mean by operating cycle? The operating cycle of an entity is the time between the acquisition of assets for processing and their realization in cash equivalent. Right? This is the LKS1 definition. The operating cycle of an entity is the time between the acquisition of assets for processing and their realization in cash equivalent. Right? So let us assume or consider an example like this. Now, let's say, for example, you are a garment factory, or you are a company manufacturing garments. Okay. So you have, what do? You bring in raw material, you manufacture or process, and then you, let's say, you export them, right? So when you export, you get money back. That is how it happens, right? Now, what happens when you go and purchase raw materials? Mostly these companies will not pay immediate cash because they will not have that amount of money. So they will purchase the raw material for credit, right? So you will have something which is supposed to be paid maybe in 3 months time or 6 months time. Likewise, you immediately. They will also want a period. Say they will pay you in 2 months time. Then what will happen? For that also there is a time period. So when you look at all these time periods, the net of these time periods is called an operating cycle. Is called an operating cycle. Right? I'm going to demonstrate this to you. Can you see the board?
Yes, sir.
Right. Now we are talking about a process where manufacturing and distribution is going to happen. Right. Let's say this is your raw material. So when you purchase your raw material, you will purchase it on credit. Right. So you purchase it here. And you are given, let's say, 3 months. You are given 3 months. Now this raw material is going to get processed. So you have the finished product. You have the finished product. So let's say let's go in terms of number of days. It will be easy for us, right? So you have 90, say 90 days. You have 90 days. Right? Then you have processing time, which let's say 15 days. Right? Then you sell it. This is your stock. You sell it. Right? So actually, for you to sell, here you create your creditor, debtor. Let's say for you to sell, it takes about another 20 days. Right? So at the point of sale, what you have said, you will give them 45 days for them to repay. 45 days to repay, right? So you are given 90 days, and for you to convert this raw material into a finished product and sell it, you take 35 days, and then you have 45 days to recover your money, right? So this is actually called debtors turnover period, right? And this is called your stock turnover period. And this is called creditors turnover period. Okay, that is, sorry, this is creditors turnover period, this is debtors turnover period. So what do you mean by that? You have done a purchase. For that purchase, you will take 90 days to repay. You will pay after 90 days. That is creditors turnover period. Then the raw material is getting converted and you will sell it after 35 days. That is your stock turnover period. Stock turnover period. We call that stock turnover period. How quickly you convert your stock into, raw material into. Then you have a debtors turnover period, which is after your sale, you have a debtor. How much of time the debtor takes you to repay. So basically, the operating cycle is equivalent to debtors turnover period plus stock turnover period minus creditors turnover period. You understand that? Operating cycle is your debtors turnover period plus stock turnover period minus creditors turnover period. So in this example, if you really look at it, it takes about 90, sorry, we might have to reduce this. Let's say to take about 40 days. So 45, 65, 45, 65, 80, 80 minus 40 is 40. So in other words, from the point of your purchase to the point of collecting your cash, there will be a lag of 40 days. There will be a lag of 40 days. That is your operating cycle. Just put the numbers and see. Debtors turnover period 45. Here it is 35. 45 plus 35 is 80. We'll make this a different number. So it will be 30. So creditors turnover period is 30. So altogether you get an operating cycle of 50. Now what do you mean by this operating cycle being 50? That is from the point of your purchase to the point of your collection of cash. You take 50 days. You take 50 days. So any business should try and bring down this number very low. It has to be a very low number. Otherwise, what will happen? You might do a sale and you have to wait for a longer period to collect your money, which shouldn't be the case, right? So it is very important that you have a manageable operating cycle. You can't have a longer operating cycle. So you can take down this. So you are a company where you purchase, right? So it will be your stocks. And you sell, right? You sell. So when you purchase, you know you have to pay, right? So let's say when you purchase here, to pay it, you take 35 days, right? From the point of your purchase, you take 35 days to pay. Because once you have purchased, they won't give you longer period, so you have to pay. After 35 days, you pay, right? Once you have purchased, let's say, so from the date of purchase to sell the stocks, you take let's say 20 days, right? So the point that you sell, you create a debtor. The debtor will pay you, let's say, after 45 days. 45. Ideally, this should have been somewhere here. 20 plus 15 means somewhere here, right? 35 days, let's say. 35 days. Here you pay. Now you see, if you take the whole example, stocks are purchased. For it to be sold, you take 20 days. For you to collect the cash, it takes another 45 days. Right? So this is your stock turnover period. This is your debtors turnover period. Okay? So basically, from the point of purchase, for you to get money on that, how long you take? You take 65 days. Am I correct? Do you understand that? From the point of your purchase of stocks to the point you convert cash, like that is you collect your cash from the debtor. How long it takes? 65 days. Is it understood?
Yes.
Right. Now, during whether you collect the cash or not, the person who has sold you the goods, that is your creditor, they will not wait. They will not give you longer period. So they will tell you, look, you have to pay me within 35 days. So look, I have paid it, or I have to pay within 35 days. Now, effectively, what is my operating cycle? My operating cycle is, by the way, this is your creditor's turnover period. That is how soon you pay your creditor. This is how soon you collect your debtor. This is how soon you convert your or sell your stocks. So basically, you have a stock turnover period of 20, debtors turnover period of 45. So it makes 65 minus 35. Basically, you have 30 days. Now, this is 30 days. 30 days is your operating cycle. So your operating cycle is 20 plus 45 minus 35, which will give you 30. So simply said, effectively, for you to sell an item of stock and get cash, you take 30 days. We call this as the cash conversion time period. Cash conversion time period. Is that understood? So this can be measured. The working capital here we say, so the operating cycle we say it is in terms of number of days. That is why we say cycle, because this is a continuous process. Again, after this you will purchase again stocks, again you sell it, again your debtor will pay after some time. So it is a continuous process. In this continuous process, what will happen? Money is also going to be going out, coming in, so many things happen. That is what called as the working capital. How that is measured?
Excuse me, sir.
Yeah.
Sir, is the operating cycle is starting from the processing part?
If you are getting it in the form of raw material, it will be yes. Because even converting the raw material into a finished product also there is a time period now. So even that should be considered, because that amount of time will be taken by the company to receive cash. Okay, I have actually stopped that part. If you look at that also, then it will be somewhere here. You purchase raw material, then you convert it to a finished product. Finished product comes into the showroom. From the showroom only it is getting sold. And after selling, how long you take to collect your cash? So basically what we are talking about is here, how soon you convert cash. Okay. So the reflection of this operating cycle is coming into the business in the form of rupees and cents, where you will have the working capital. Yeah, sometimes what happens, this creditors turnover period could be a larger number, right? Larger number. What do you mean by that? Creditors turnover period, let's say you have here something like 75 days. Is it good or bad? Having a creditors turnover period of 75, is it good or bad?
Bad,
Why?
because the operating cycle will be a negative one.
So is it bad? Having an operating cycle of negative means, is it bad?
It's good, sir.
It's actually good. You know why? When the creditors turnover period is more means you can delay your payment for 75 days. Now nobody will like to pay money immediately. No? Even you and me also will not like. Now say for example, we do purchase from the credit card, right? So when you I mean, let's go back to the principles. When you get new credit card, what is the first thing that you will ask? If you are to get a credit card, what is the first question that you will ask?
Credit limit.
Yes. Oh yeah, credit limit is there. But rather than that, what would be the most interested
Credit period.
period? I of course will be very interested in looking at the credit period. Why? Because I want to know if I do a purchase today, how long I can delay the bank paying, isn't it? Now normally the credit period is given is 50 days, 50 or 51 days. But people would like to have it maybe say 100 days, where they defer their payments to the bank, right? So I can easily delay this payment. What is the repercussion? What is the repercussion? Repercussion will be when you delay your payment to this supplier, When you delay your payment to the supplier, will this supplier willing to give you again on credit terms? He might say no, because he might say, look, even last time you took about 80 days to pay me. I can't do this. I can give you only credit period of 40 days. What will happen? You might lose your supplier. You might lose your supplier. So there is no good or bad operating cycle. That is what you need to understand. An operating cycle should be managed at the optimum level. That is what you need to understand. Operating cycle has to be managed at the optimum level, not very longer one, not a shorter one also, because it will have both will have impacts. Okay, so it is very important how wisely you manage your operating cycle. How wisely you manage your operating cycle. So as a business concern, I would like to minimize this, because I don't want to keep my stocks in the showroom for a longer period. Now, if this is too large, let's say it is not 20, it's somewhere around 50 days. What is the impact? Can somebody tell me? What is the impact if this is not 20 and let's say it is 50? Can somebody tell me?
It will take more time to pay to the debtor, creditor.
No. You might keep this in the showroom, because anyway you are not going to pay it out of this money. No. For this payment you need to have money. You can't connect these two. Overall, if you take the business, yes, I understand there is a connectivity, but if you take a single transaction, this is a separate transaction and this is a separate transaction. You can't wait till the money is collected to pay this. This payment will happen from your money that you already have. But this is a continuous cycle. That is why we call it as an operating cycle. But my question to you is, what happens if this 20 days becomes 50 days? What is the impact? What is the impact to the business?
Working capital.
Working capital, there is impact, but let's try to understand in simple terms. Just think about using your common sense. What will be the impact if this 20 days becomes 50 days for you to sell? Now I'll give, let's say you go to a just I'm taking the names just to explain you better. Let's say you go to a SoftLogic showroom to buy a television, right? So you have gone today and you have looked at the model and everything, price, everything is there. You go after maybe say 1 month, after 1 month time, still the TV is there. Let's say this particular TV is there. Exactly whatever, it may not be the correct example, but let's say that is the only TV that is there in the showroom. That TV is still there, right? Now tell me, what is the impact?
The selling price.
Pardon?
Selling price.
Yeah, selling price. One is selling price. You can't increase it. It has to come down, right? Because you are not in a position to sell this product. But more importantly, what will happen? When you are holding a product for a longer period in your showroom, it can become easily outdated. Do you understand that? We call it as obsolete. If you look at a mobile shop, what do? Their turnout is very high. Or even without a turnout, they have to remove their old mobile phones. They can't keep it. Why? the models keep on changing. When the models keep on changing, what you have to do? You have to look at selling the mobile phones very, very quickly. If you keep one model for a longer period, it doesn't make sense. The demand for the product will be lost. So likewise, in every business, it is there. You have to be very, very clever on converting or selling the product from the showroom very, very quickly. So you need to try and minimize this. Of course, you can have a benefit out of here. Sometimes if you say, no, I will give you only 20 days of credit period. When you say 20 days of credit period, people might not come. Sure, you might have to increase. Nowadays, what do you know? If so, no one is having the interest-free installment plan, nobody will buy the product. So the businesses have transformed into a greater level. So you need to understand these intricacies that are there in the businesses. So reducing the stock turnover period is good, right? This and this, you have to manage it accordingly. That is, you have to manage it in line with your business. So delaying this is good. Delaying this means you can take 70 days. It's good. But what will happen? Sometimes your suppliers might not be willing to give you the next time because you are taking too long. Reducing it also will have a problem. Why? Then you might fall short of cash to pay this. Because if you bring this 35 days to 15 days, you have to pay it immediately. By that time, you wouldn't have sell it also. So that is also not good. So you have to maintain this. That is what we call as optimum level. So there is no benchmark number of days for this. It's only by practice and experience it happens in businesses. And it might vary from business to business. Here also, you can give a shorter debtors period. But what will happen? People might not like it. They might don't want to do business with you. But having said that, you can't give a longer debtors period also. Why? Then it will hamper your entire business. You are not collecting cash. Let's say you give somebody 90 days. And you are waiting till 90 days to collect the cash. And after 90 days, that person says he can't pay. What happens? You have not collected your cash. So those are the issues that you might come up or come across with these operating cycles. So operating cycles have to be managed properly in order to manage your working capital properly. So what is working capital? Working capital is your current assets minus current liabilities. Current assets minus current liabilities. That is very important. Working capital is current assets minus current liabilities. So have this formula, very, very important. Okay, in examination, this could be tested. Okay, any questions? If you have any questions, you can ask. So operating cycle of an entity is the time between the acquisition of assets for processing and their realization in cash equivalent. Okay, right. Current assets therefore include inventories and trade receivables that are sold, consumed, and realized as part of the normal operating cycle. So what you will have under current assets? Your inventories, your stocks, and then you will have the trade receivables or the debtors. Then on your current liabilities, you will have your creditors or trade payables. So effectively, the net of these will be your working capital. Working capital. Right. That brings us to the end of this topic. Any questions? Do you have any questions? You can ask now if you have any questions. No questions. Okay. So then let's move to the next topic. Yeah, I'm not actually doing the bank reconciliation. We will do it in the class actually. Once I get the opportunity to go to the institute, definitely we will do it. Right now, I'm not taking those because I'm unable to do those because I need the board. It has to be a larger board that I can handle it. So right now I'm just using a smaller board. That's why I'm not touching on these questions. Definitely we will do it when I start going to the institute, of course. Okay, right. So now we are going to look at a new topic, which is a sole proprietorship. Can you all see the screen?
Yes.
Yes, sir.
Right. So the handout is already available in the portal. I think yesterday they uploaded it. So, right. So what is a sole proprietorship? What is a sole proprietorship? Yes, quickly, you need to answer because having a 3 weeks break, you should have revised all what we have learned. What is a sole proprietorship?
It's a business owned by one person.
Yes, that is an individual. Correct?
Yes.
Yeah, that is like my car, my petrol. Okay, I am responsible for everything. Whatever that I do, I am the one responsible for that. So a business run by an individual is called a sole proprietorship. Okay, right. So non-manufacturing entities are trading entities, as I told you, which are engaged in the purchase and sale of goods. Right now, you have financial institutions, then you have trading organizations, then you have manufacturing organizations. Right? Manufacturing organizations are separate. Trading organizations are ones which fall in between these two. Okay, trading entities, what they do, they buy goods and they sell goods. So when they buy and sell goods, their objective is to make a profit without changing the form of the good. Say for example, if you are running a grocery shop. Now this grocery shop will have so much of goods. Milk powder, of course, nowadays there is no milk powder, but you get so much of products like those. Now when you are running this grocery, what happens? You will buy the product from somewhere else as it is, and you will sell it to the consumer. You can't change anything. But in a manufacturing organization, what will happen? They will bring in the raw material, the cloth. Then during a process by that manufacturing organization, they will produce garments. So that is a different process. But here what we are talking about is a trading organization where I will buy products from another place at wholesale price or whatever, and I will send it to the end user or the consumer. While doing that, I can't change the form of the good. Form of the good means if you get anchor packet, a 1 kilo packed in the way that it is, yet you see, it has to go back to the consumer also in the same way. You can't do something in between and put your brand or do anything. Okay, that's not permitted. So trading organizations are ones which sell goods at a profit without changing the form of the good. Non-manufacturing organization, or in other words, the trading organization, do not process the goods purchase and sell them in its original form. So when we talk about trading businesses, the sole proprietorship is also a form of business where the owner is actually running the trading business. Now, you might have seen a lot of small shops, maybe in your area or maybe in your town or maybe in your village. Now, all these people are sole proprietors, right? Now, those days we call it as the pettikade. So the pettikade is actually a sole proprietorship because that person runs his own business, right? Maybe it's a large business or a small business, it doesn't matter. Still, he is running a sole proprietorship. Okay, and it is a business. So that prominence have to be given for that particular business because every product that is sold there is with the objective of making a profit. That is what is important end of the day. Look at this arrangement, how a sole proprietorship works. Now, in a sole proprietorship, there is a capital investment. Now, who does this capital investment? It is again the sole proprietor. He puts in his own money. He puts in his own money. Or what he will do is, he will borrow from a third party. Now, say if I am with the intention of starting a small business of my own, what do? Either I have to prepare my own funding through my savings to start this business, or I need to go to somebody like my father, brother, or maybe say from a bank. I need to borrow. But when I borrow from there, it is my personal liability because I need to pay back because I haven't established the business yet. So until the business is established, my borrowing is a personal borrowing. That is what this flow chart that is shown there as third party giving money to the sole proprietor. Now, once this money is available with me, I start the business, which is my sole proprietorship. Now, in the sole proprietorship, what will happen? I'm going to do business. With whom? Again, with so much of third parties. It's not the same person who lent money, but it could be so many other people. So when you are dealing with these people, what happens? There are obligations where you have to pay. There are receivables where you need to collect money. So there is a business happening. There is a business happening. So buying and selling means there is some interaction between with the third parties, which will result in a receivable or a payable. That is where the whole concept of debtors and creditors come into the picture. What are the advantages? It is very easy and low cost because there are no much formalities. If you think today, you can easily start a small shop in the front of your house. Maybe the front portion of your house can be converted into a shop and you can start a business. Nobody will question. The owner's right to make all management decisions concerning the business. Now, I have already explained, in a larger business concern, the board of directors only will make the decisions. But here, it is the owner who is going to make the decision. That is why I said, my car, my petrol. I can do whatever I want. Okay? The sole proprietor owns all of the business and has the right to receive all of the business profits. Now, when it is run by one person, whatever the profit that is made out of the business belongs to him. There is no argument about it. But having said that, we always think that the business and the individual are two different. Okay? Because business is a legal entity. So we don't interact with the business and the individual. You should not do it. The moment the individual interacts with the business for his own preferences, then it becomes a drawing. I have already explained this. Anything that you take from the business has to be a drawing. That is why we classify it as a drawing. You should not take money or goods from the business in the way that you want. A sole proprietorship can be easily transferred or sold if the owner decides to do so. So a sole proprietorship can be easily transferred or sold to anybody when they want to quit the business. Okay? Is that understood? Because you are the one who is making the decision. So you can decide at any moment, now I want to sell this business. So chapter close. Right? So those are the advantages. Disadvantages. The sole proprietor's access to capital is limited to personal funds plus any loans he or she can obtain. Very true. As I told you, when you are running a small shop of your own, if more money is required, you can't have it because you don't have access to capital. Either you have to bring from your savings or you have to borrow from the bank. Even the bank will not like to give you money because you are just a small business concern. So access to capital is very limited. So the sole proprietor is legally responsible for the business's contracts and the torts committed by the proprietor and his or her employees. That is, the sole proprietor is legally responsible. Now say if you are running a shop and you have, let's say, 3 staff members working under you, you have 3 employees. Apparently, 2 of the employees are below the age of 16. Let's assume that's just for example. But you are running the shop and you have been running the shop for a longer period. Nobody questioned. All of a sudden, there is an inquiry against you. That is why you have deployed 2 people at your shop who are below 16 years. That is violation of the law. Illegal. So when something like that happens, you are responsible. You are personally responsible for that. But if it is a larger business concern, it is not the individual, it is the business who will be responsible. So here, any part of irregularities, torts that are committed by the business or by you or by your employee, end of the day, you are responsible. So like every other business, a sole proprietor also will have to measure their performance. That is your profitability. How we measure the profitability? The profitability is actually measured at 2 levels. We call that as gross profit and net profit. Gross profit level and the net profit level. Okay, we will look into details what these are. The financial position of the business enterprise is judged by measuring the assets, liabilities, and debts. So that is very straightforward. Financial position will not change from company to company or business type to business type. That will be similar. But the difference here is, in a sole proprietorship, we measure the performance in terms of gross profit and net profit. Gross profit and net profit. Okay. So let's now look at the income statement or the P&L statement of a sole proprietorship. The income statement of a sole proprietor will have 2 components. We call that as the trading account and the P&L account. Trading account and the P&L account. So the trading account will give you the gross profit and the P&L account will give you the net profit. Okay, please mark those. Trading account will give you the gross profit. P&L account will give you the net profit. So what do you mean by gross profit? Gross profit is the difference between sales and cost of sales. Very simple. You do a sale and you have some amount. In order to do that sale, you would have brought in goods. The cost of the goods that you have is called the cost of sales. So it is the difference between the two will give you the gross profit. Gross profit. This is the simple structure. Look at it. How a trading account of a business will look like. So all the terms that you see here are already learned. Books of prime entry. Can you recall that? When we learned the books of prime entry, all these were known to you. Sales, sales return. Purchase, purchase return. Then opening stock and closing stock. Opening stock is at the beginning of the period or the financial year, how much of stock you had in terms of value. We are talking about in terms of value. Then at the end of the year, what is the value of the stock that is left over, right? So basically, if you look at it, the sales or the net sales is sales minus sales return. Cost of sales is where you take the opening stock, add all your purchases, remove your purchase returns, okay, or the return outwards, remove the closing stock, then you get the cost of sales. Sales minus cost of sales is the gross profit, or it could be a loss also. Is that understood? If you have any questions, please ask. Do you have any questions here? If you have any questions, you can ask. No questions. Okay, is that clear? Right, then we go on to the net profit. So net profit is calculated from the gross profit. That is the starting point. So from the gross profit, what you have to do is you have to add any other income that you might have. Now, apart from your main business, that is your trading business, you might have other income. Like you might have had an investment relating to the business. So that investment might give you some interest. Those will be your other income. Then after adding that, you have to deduct all the other expenses. That is, if people are working under you, might have to pay salaries. If you are to distribute goods to the doorstep of your customers, then you might have delivery expenses. Sometimes you might have taken a loan for your business, so you might have to repay interest to the bank. That is finance expenses. You might have to pay for electricity. That is all your utility, administrative. You might have to pay rent for the business premises. Sometimes you might not have your own premises, so you have to pay rent. That's all administrative. So those are all called overheads. Please make a note. Those are called overheads. Now, when you are calculating the gross profit, none of these overheads will come. Okay. Again, I'm going back to the gross profit. When you are looking at the gross profit, what you deduct is only the cost of sales. Cost of sales means anything that you have incurred in relation to the product, the products that you sell. So your purchases, purchase return, maybe sometimes you might have carriage inwards. Carriage inwards means, you know what it is. Carriage inwards, the charge you pay to bring in the goods into your business, right? That is carriage inwards. So that will be also cost of sales, part of cost of sales. But what we are saying here is all the overheads means which are not directly related to the products. These are all related to your business, like the administrative, selling and distribution, loan interest payments, all those are overheads. So from your gross profit plus the other income, when you deduct the overheads, you get the net profit. So by the way, you have to remember this is totally different to the financial statement that you may learn for any other organization. Okay, this is very simplistic financial statement that you learn for a sole proprietorship. But when it comes to the larger company or maybe a bank, it is totally different. Okay, so one such example is the one that I showed you, the Haley's. You can look at it. But even in Haley's, I will show you that some of these lines will be there. Okay. Yeah. Can you see this? Can you see the screen?
Yes, sir.
Now you see revenue. That is your sales. Then they have cost of sales. That is this amount. Okay. They have included something called a direct interest cost. We don't know what it is. You might have to go to details. But then what you get is the gross profit. So they have a gross profit of 50 billion. Right? Then they have all the other income, group dividend, other income. Then they have the expenses. You see distribution expenses, administrative, other expenses. You all see that? So whether it is a sole proprietorship or a trading business, moreover, those are similar. But in between, there can be differences depending on the type of business. But when you look at a bank, it's totally different. You see, you don't get anything to that effect. It's totally something else. Okay, that's why I wanted you all to go through the financial statements. Go to the stock exchange website and go into the different types of companies, maybe a trading company like Haley's, John Keel's, maybe a hotel industry company, maybe what do you call the tea plantation. So just have a look at those financial statements. What are the items that they show in their P&L, in their balance sheet? Just make this time very productive while being at home, or maybe say sometimes most of you might have be going to work on a roster basis. So just make use of that spare time to go through these and revise your work. Okay, right. So that is the P&L. So these are the items that will be included in the administrative expenses. Salaries paid to staff, rent and rates, heating and lighting, printing and stationery, telephone charges, postages, legal and other expenses. Then selling and distribution will include salesman salaries, commission to agents, advertising, packing expenses, export duties, maintenance on distribution of vehicles, insurance of finished goods. This is one item where, relating to the early example, when you keep your stocks in your showroom for more days, that is the stock turnover period, what will happen? You have to pay more and more insurance. You have to pay more and more insurance. You have to remember. Then bad debts. Bad debts is where your debtors are not paying. So then you have to write off. Right. This is the simplest form of a balance sheet where I have captured all the items. Okay. You don't have to worry about this because generally you will not get a balance sheet of this kind to be prepared. So just for example, I'm showing you. You can have a look at this. So right earlier said, when you look at a balance sheet of sole proprietorship or a trading organization, non-current assets, then only you get the current assets. So what you see here is all non-current. Then here what you have is the current assets. Then you have the capital. You see, when it is a sole proprietorship, you will have the net profit, the capital of the business. And if the sole proprietor has taken anything in the form of drawings, you have to show it here. Then comes the non-current liabilities, and finally the current liabilities. Current liabilities. Any questions? Any question that you have? If you have any questions, please ask. No questions. Everything is very clear. Okay. Right. So if that is the case, what I'm going to do now is I'm just going to close for today. Of course, we are 10 minutes earlier. What I want to do is I want this to be done by you all. Okay. So next week I will start with this question and then we will get on to the next topic. Just look at the two templates that I have given, that is this and this, right? And I want you to do these two questions. That is where you need to prepare a trading account and then you have to prepare a balance sheet. Okay. Then you also give a try to do this March 2017 question number 3. Okay. Those 3 are the homework for you all. Don't try to look at model answer books or anything. I don't think you will have. Even if it is there, don't refer to those. Just try to do this question, have a look at it, and answer to the question that they have asked. Okay, you can do it. Next week, what we'll do is we will start off with these 3 questions, finish it off, and then we will proceed to the next topic. Okay? Right. So take care. I will arrange for some latest financial statements of few companies in the portal. I will speak to the IBSL and get it arranged. But in meantime, I think you might have to do a thorough revision work with whatever that we have learned so far. And make it a point that if you have any questions, you can always ask at the beginning of the class before I start so that we can answer those and then we'll proceed with the lesson. Okay. Right. So take care and goodbye.